Investors will be mainly looking at governments' efforts around the world to slowly ease the lockdowns they've imposed in response to the COVID-19 outbreak. They'll also be looking toward what progress is being made on combating the virus on one hand and reviving the economy on the other. It's going to be a difficult balancing act, and two sets of numbers which may give some sense of the challenge ahead are due out in the UK this week. The first is the latest unemployment data on Tuesday the 19th of May. The second, the inflation figures due the day after, Wednesday the 20th. The unemployment figures will cover the 3 months at the end of March. They'll just start to catch the effect of the lockdown that was imposed at the end of the month. Remember that as of the end of February, unemployment was 4%, the employment rate was 76.6%, a record high, and growth in wages was 2.8% year on year, including bonuses. On the inflation front, prices rose by just 1.5% year on year, according to the Consumer Price Index, or CPI, for March, thanks mainly to falls in clothing and also fuel, which is a product of the collapsing oil price. Things got worse for oil in April, so that may affect the headline figure again, but it'll be interesting to see how the numbers work out, given the depressed overall level of economic activity and the reduced number of transactions. Food buying, however, could have conceivably had an upward effect. If there's any good news here, it's that wage growth is running ahead of inflation, even if it's been cooling for a bit. Those lucky enough to keep their jobs will therefore have a few more pounds in their pocket in real terms, once they're finally allowed to leave their homes and roam a little bit more freely. On the company front, firms still have the option to take extra time to publish interim or full year results, so the timetable's a bit provisional. Please therefore bear with me, but there are a good few releases due from big, mid and small caps which should be of interest, either in their own right, or for the insight they may provide into what's happening in the broader economy. Names to note include FTSE 250 gold miner Centamin on Monday the 18th of May, Sales and Support Services Group DCC and Food Group Greencore on the 19th, Utility 7 Trench, Retailer Marks & Spencer, Support Services Groups Experian and Compass, and Real Estate Investment Trust Great Portland Estates on Wednesday the 20th, Intertech, Big Yellow and car retailer Inchcape on the 21st, and, for a big finish, Burberry, United Utilities and Spectris on Friday the 22nd of May. But the company which could cause the biggest fuss in the week ahead just might be tobacco giant Imperial Brands. It's set to release its first half results on Tuesday the 19th of May. The shares are down by almost a quarter over the past year at the time of recording, worse than an 18% fall in the FTSE 100 over the same time frame, and by way of another contrast, sector-rival British and American tobacco shares are up 6% over the past year. The poor performance of Imperial is easy to understand, however, in the context of a tumultuous 12 months, which has seen the company dish out 2 profit warnings, scrap its trend 10% dividend growth target, and change both chief executive and chairman. New boss Stefan Bomhard will take the reins on the 1st of July when he joins from Inchcape, and with joint stand-ins Dominic Frisby and Jörg Biebernick will be unveiling the first half results. When they do so, Imperial Brands' performance will be benchmarked against 4 metrics in particular, all of which were flagged alongside February's profit warning. First, group net sales growth for the year to September 2020, which Frisby and Biebernick flagged would now be 0 compared to their previous target of 2%. Second, sales growth in next generation or NGPs, or which management admitted would miss the goal of 50% growth. Third, and this was the good news, low single-digit percentage revenue growth and faster profit growth from core tobacco, helped by strong trading in America and also Europe, where price increases offset volume declines. And finally, to sum the lot up, adjusted earnings per share were expected to come in slightly down from last year's 273 pence rather than come in flat. Even that, however, looked a bit of a reach, given management's forecast of a 10% drop in the first half alone, down from 115.6 pence a share a year ago. That then takes us to the balance sheet. Imperial Brands finally sold its premium cigar business for just over £1 billion in April, although that's after the first half end. It was also below asset value, published of just under £1.3 billion in the annual accounts, but at least it allows Imperial to reduce net debt, which, including a pension deficit, stood at £10.7 billion last September. Lower debt means less risk and also lower interest payments, freeing up more cash for investment in the business and potentially dividends. Imperial's cash flow still covers the forecast £1.8 billion annual dividend payment after capital investment, tax, interest, pension contributions, albeit only just. Income seekers will be pleased to see that continue, especially as the company is the 10th biggest dividend payer in cash terms in the FTSE 100 based on last year's numbers. Now, Imperial pays dividends on a quarterly basis, and for the last financial year, the payments went 31.3, 31.3, 72, 72, for a total of 206.6 pence a share, as they were distributed in June, September, December and March. An unchanged sum this time around would imply a 12.7% dividend yield, the third highest level in the FTSE 100. But intriguingly, analysts have penciled in a very slight reduction for this full year to around 202 pence a share. That would be a shock, as Imperial's increased its annual payment every year since it was spun out of the Hanson conglomerate way back in 1996. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.